Hello everyone, welcome to our discussion of Chapter 16. We're talking about variance analysis in Chapter 16 and 17. We skipped 15. Back in 13 we learned about budgets and basically talked about it in terms of a static budget, meaning we planned one level of activity that will allow us to make sure that we have the resources necessary to run our business, reach our goals. Remember, we made a lot of about our goals. And then in Chapter 14, we talked about how we evaluate against those goals and use evaluation to decide who's doing well and who needs to improve. Another way to evaluate is to use the budget as the comparison. All right, and that becomes a little bit problematic. While it's helpful to compare against the budget what we actually did to see where we end up, especially to improve our predictions in the future, but in an evaluation standpoint, it becomes a little bit tricky in that we budget for a particular level of activity. And what that means is that we plan on selling 10,000 units and we have a budget for all our costs based on 10,000 units. Well, if we only make or sell 9,000 units, then our costs, even if we didn't do a very good job, we would expect to be lower because many of our costs are variable, right? And so they'd be lower in a situation where we made 9,000 instead of 10,000. So should we still compare our costs at 9,000 that we actually made with our budget cost at 10,000? And that seems rather ridiculous, and yet we don't have a good way to do that unless we use what's called a flexible budget. So in this chapter, we'll talk about a little bit that situation. We'll talk about having a flexible budget and being able to take our budget and adjust it based on what the actual activity is. And then we create, in essence, a standard on a per unit basis, and that standard cost becomes literally a budget per unit. And so we look at it on an individual unit basis and compare the costs that we expected for that unit, all right, with what actually happened. And not individual units, but on average, what the total units on a per unit basis cost. And we evaluate based on that, okay? And that is not subject to the ups and downs of the sales volume and so forth like that. It makes it easier to see the individual pieces independent from the sales. Now we'll consider how we didn't meet our sales goals and that sort of thing also in our variance analysis. All right, so that's where we're headed. That's what we want to talk about. We're going to do it in 2 chapters. It's that important in terms of evaluating our performance. All right, key thing is, remember, okay, variance is a difference. Not good or bad, right? It's just different than what we planned. So remember that initially. So a variance is just different from what we expected or different from what we planned or what we budgeted. Okay, a favorable variance is one that would increase our operating profit or decrease our costs, okay, which also increases our operating profit. Unfavorable variance, okay, reduces operating profit or increases costs. We paid more. Okay? So variance by itself is not positive or negative, but we have favorable and unfavorable. Now, we do want to not put too much emphasis on favorable and unfavorable in the sense that we always want favorable variances, but never want unfavorable variances, okay? Because some favorable variances may actually, in fact, many favorable variances may actually be a bad thing. So, for instance, if we are selling, a really egregious example, if we're selling double bacon cheeseburgers and they are to be 1/3 of a pound of hamburger, okay, and we short that, meaning we put less hamburger in each of our patties so that we're actually selling less hamburger, we'll have a favorable variance, meaning we'll have less hamburger than what we planned, and that will result in an increased operating profit, at least in the short run. But if customers are not happy, or the quality of our whatever it is we're providing is being sacrificed because of that favorable variance, maybe an employee is doing that just to cut costs without thinking about how that's going to play out in customer satisfaction. So typically we want to look at variances from what our plan is on both favorable and the unfavorable side. So this is one way you might look at our results. So we had a master budget that we created along the lines of what we learned in Chapter 13. And on the left here in this slide is our actual results. All right, so we already see that sales in units was quite a bit below what we planned. And you can just glance at some of those and you see that that also resulted in our costs being less than what we planned. All right, and we put the variances in the middle, or we can put the budget and the actual right next to each other and put the variances to the right. Nothing magical about that. However, it makes more sense. Some people like to see it in between. Some of them like to see it to the right. Even you could put it to the left if that made more sense. Let's see, we have an unfavorable variance because we sold less than what we planned. That's going to cause us to have less profit. But we have a favorable variances for our variable cost. And we would expect that because we had made fewer units. And so we would expect fewer costs. Is that because we became more efficient or we did a good job of managing those costs? We need to break it down more. We need to use a flexible budget to determine that, because here it really becomes hard to say whether or not our variable manufacturing costs are good or not. Because what would we have expected our variable manufacturing costs to be if we had planned to make 80,000 instead of 100,000? Because the manufacturing supervisor has nothing to say in the unit sales. The fact that we sold 20,000 less than what our plan is not their responsibility. So they really should not be evaluated based on the overall manufacturing cost compared to the master budget, but rather compared to what it should have been to make 80,000 units. So that brings us to the idea of flexible budget as opposed to a static budget which has one level of output. Okay, single activity level. Flexible budget, by breaking it down into a per unit cost, allows us to flex and look at what we would have expected to happen at literally any level of activity. So if we start our process of evaluating our performance compared to the budget, we start with the sales activity variance. Okay? We have, that also could be called the sales volume. That's because we've sold a different number than what we planned. So we already noted that. We see that the master budget was 100,000 and based on 80,000, okay? That's the flexible budget given here, right? Because we want to match that. The variance is 20,000 units, which represents $200,000 of revenue. So we were down that much. See, but this is also, because this is a flexible budget, we have now redone the variable manufacturing costs, okay, to meet or to be what we would expect to have happen at 80,000 units. All right, we'll bring those in a little bit late in next slides. But right now we're focused just up here on this sales activity, okay? So that is the first piece. Then we look at the profit variance, okay? What caused us to make less money than what we planned? And this is where we're going to bring in the sales price variance, variable production cost variances. And so when we're talking about variable production costs, we're talking about direct labor, direct materials, and variable overhead. And then, of course, our fixed production cost variances are fixed overhead. All right, and then we can have marketing and administrative cost variances. We're not going to spend a lot of time on those. Those are usually fairly straightforward. Okay, so now this looks kind of complicated, all right? But what we want to focus on is, remember, this was the master budget we started with. This is the flexible budget. We already noted this $200,000 sales activity variance. We were off 200,000 or down 200,000 in sales just because we sold less, 20,000 units less. But our actual revenue was 840,000. So if we sold 80,000 and we got revenue of 840, we must have sold them for a little bit more than what we planned. All right, and that caused us to have a $40,000 extra, you might say, or a favorable sales price variance. So we did sell less, but we sold the ones we did sell for more. So that kind of offsets. So you might say together, the total variance between the actual 840 and the million is 160, right? A 200,000 unfavorable sales activity because we sold less units, and 40,000 favorable. Those offset each other, okay? Because one's favorable, one's unfavorable, and that's a concept that we want to get used to, is that they can offset each other for 40,000. So total variance between that master budget, okay, 840,000. Now, from the rest of these, we're really comparing the actual to the flexible budget, because everything that is different between the flexible budget and the master budget is entirely because of the sales activity. That's the only reason those exist. Okay? So we're going to take the flexible budget and compare it to the actual. Now we're going to lump all the variable manufacturing, direct labor, direct materials, variable overhead together. I'm going to say that we spent $329 when we should have to make $80,000. Remember, keep that in mind. To make $80,000, it should have cost $304. And it actually cost us $329. So that's unfavorable. We spent more than we should have for that many units. See, that had been covered up by our sales activity variance when we were looking at the budget to actual, which is why it's so important that we have the flexible budget here to compare. But on the selling and administrative variable, we should have spent 72 at 80,000, but we only spent 68, so that's $4,000 favorable. Now the fixed manufacturing costs, they shouldn't matter, right? They should not be at all influenced by the changes in sales activity if they're truly fixed. Okay, but in this case, so we found some way to spend less by to the tune of $4,500. That's favorable on manufacturing overhead, and $76.80 less in fixed selling and administrative costs. Okay, and they just have the two columns, marketing administrative variances in one, and manufacturing variances in another. Okay, so now we have explained in more detail, okay, what has happened, why our profit was actually 114 when our plan was 190. Now 106 of that was just sales activity, okay? So we actually if you look at this flexible budget, we're favorable 30,500. We actually made more profit than we would have thought we would make at 80,000 units. All right. So now we're going to take each of those pieces and look at more detail, okay? So that we can see what it was that caused our good things or bad things. So we find, first of all, the sales price variance. We break it down and we see that we charge $10.50, okay, instead of $10. So raise the price and times the 80,000 units we sold, right? And so that's a $40,000 favorable variance because we charged more. That's going to increase our profit. Now, maybe that increase in price was one of the reasons why we sold fewer units. And we could argue in this case, that was a bad decision because we got a $40,000 more in additional sales price, but we reduced the number of units by 200,000, caused a $200,000 drop in sales revenue. Now, that may not have been the only reason for our drop in volume, okay? But if it was, then that was a poor choice in that regard. Now, looking at our variable production costs, we're going to develop a standard cost. Remember, a budget per unit for each of our inputs. Direct material, which in this situation is a powder of some sort, we are supposed to use, we have a plan to use 4 pounds for every unit we make. And each of those pounds is supposed to cost 55 cents. So we're got the cost for materials, assuming this is the only material, is $2.20 to make 1 unit of our output. That's 4 pounds times 55 cents. So the point is, 2 things can happen, okay, that will impact our actual versus this standard. we can use more or less pounds, okay, more or less powder than would be planned. We could use more than 4 pounds per unit or less than 4 pounds per unit. Okay, we could buy it for more or less than 55 cents per pound, because prices change, right? Any change in that would give us a result that's different than $2.20. All right? And what we want to try to do is identify what's causing the difference so that we can adjust going forward. Maybe there needs to be adjustment into the standard so that we budget more properly, or maybe our performance needs to be brought up to what we should have it for a standard. Maybe, like we said, there was a favorable variance in how many pounds. Maybe we've been shorting the material and that's causing a problem. And maybe that needs to be rectified. Maybe there's something about how our process is that wastes some of those pounds of material that we can fix. Okay? So that's why we break it. We want to look at the detail. Otherwise, we may not see what it is that's causing the problem. Direct material is supposed to take 0.05 hours, and our people are paid $20 per hour. So again, if you're going to be different, so that's $1 per output unit. You could have people that aren't working as quickly or more quickly than we planned, or they could be paid more or less than we planned. Variable overhead, if it's based on hours, then you would use that. Okay, and then we have a rate that we standard. That's the cost, the supervision, utilities, all those variable overhead costs that are in addition to paying our people that actually work on the product. Now, if variable overhead is done using machine hours or some other level measure of activity that we learned about back in activity-based costing, then we would then have our standard quantity per whatever that cost driver is. So if it was machine hours, it would be how many machine hours per unit of output. And then what's the cost to run those machines? Electricity, maintenance, all that stuff would be per whatever machine hour is used. Okay? So literally, you would create a predetermined overhead rate that we learned about way back earlier on for this variable overhead based on the cost driver. To translate that in a per unit, in this case, of drink, okay, variable overhead. So our variable costs are supposed to be $3.80. So literally, you want to build your flexible budget, you know what the cost should be at whatever level. You want to make 6,322 units of drink, then your direct material should be 6,382 times $2.20. Your direct labor should 6,382 times $1. Your variable overhead should be 6,382 times 60 cents. That's how you build your flexible budget. Now that may not match exactly what our static budget was that we came up with at the beginning of the year for the whole year, but for valuation purposes, the flexible budget is far superior. So once we know and have some actual costs and we know what our flexible budget is, and notice that the column 3, if you will, okay, is a flexible budget. Column 1 is actual, and this is kind of a graphical way of representing our calculation of the variances. So direct labor, direct materials, variable overhead are all going to have price variances and efficiency variances. So if you look at the actual and compare it to the standard, notice that in the formula, the actual quantity that you bought is the same. The difference is the price, right? The difference between the actual price and the standard price. Both of them are multiplied by the same actual quantity. That gives you, that difference is your price variance. Notice what's different here. The quantity is different. The standard price is the same. The actual quantity used of materials, labor, overhead, and what we should have used. So this is about being efficient. This is about what price we paid for this stuff that goes into our product. Together, that total variance, all right, remember a positive, favorable, unfavorable offset each other, right? So the total variance is, if they're both favorable, you add them together, both unfavorable, you add them together. If they're going the opposite direction, then there's a difference. So that's kind of a graph, and that applies to direct materials, direct labor, and variable overhead the same way. If you like the formula process a little better, that kind of visual diagram doesn't work for you as well, okay? Then you can use this formula, take the actual quantity of whatever it is you're buying, whether it be direct labor, direct materials, variable overhead, okay, and multiply it by the difference. Notice what it is, difference between what we paid and what we should have paid, what we planned on paying, okay, in parentheses, multiply that out, and that gets you your price variance. Okay, remember, a favorable variance is when we paid less, okay, than we planned. Unfavorable, paid more, or more profit is favorable, less profit is unfavorable. And here's your formula for the efficiency variance. Okay, by rearranging the terms, you get the standard price, and you're looking at multiplying it by the difference in the quantity. Okay, so that's the kind of the more formulaic way of looking at it. And then we also earlier showed you the kind of a graphical or a diagram way. Same thing, same result. Whichever one makes the most sense. Maybe for a little bit you do it both ways just to check yourself. Okay? So putting some numbers in this for direct materials. All right? The actual price we paid for our materials was 60 cents. Okay, we bought 328 pounds. So we multiply those together, 60 times 388, and we get 196,800. Now, in the middle, we're looking at the standard price. Now, remember, our standard was way back here, right? 55 cents per pound, right? That's our standard. So that's what we're going to use. And we multiply that by 328. So we actually paid 60 cents. We should have paid 55 cents. Okay? So 55 times 328, 180,400. Using the kind of diagram way, we take the difference, and we paid more than we planned, and so it's a 16,400 unfavorable price variance. Now on the other variance, the efficiency variance, we're using standard price in both places, but we actually used, we should have used 320. We actually used 328. We should have used 320. Because we were making 80,000 and we were supposed to use 4 pounds for each unit. So 80 times 4 is 320. but we actually used 328 because we bought and used the same amount, right? All of this, the 328. So we take the standard price times the actual quantity and standard price times the standard quantity. Okay, take the difference and we get 4,400 unfavorable efficiency variance, right? Because we used more, 328 versus 320, than we planned. Because they're both unfavorable, we add them together and our total direct materials variance is 20,800. So we spent more and we used more than what we planned. Okay, that's going to impact negatively our profitability. Direct labor works the same way. We have a price or a rate variance, an efficiency variance. We compare the actual price with the actual quantity of hours, the standard price. Now, these actual things will have to be given to you. It's not like you can just dream them up, okay? The standard price was $20. That was what we used when we made our plan. All right? And so at 4,400 hours, we paid $79,200. We should have paid $88,000. So we have an $8,800 favorable variance because we paid less than what we planned per hour. Okay, on this side, the standard price is the same, but the number of hours, actual quantity of hours, was higher than the standard, what we should have. We should have used 4,000, and we used 4,400. Okay, so 88,000, subtract 80,000, we got an $8,000 unfavorable variance. See, these two offset each other. We had a favorable price variance, so we paid people less, but they were less efficient. Maybe there is a relationship between those two. Maybe because we paid them less or we used less expensive workers that have less experience, they were not as efficient. In this case, it kind of negates itself out and our ending variance is very small, okay, because they offset each other. Variable overhead. We would be given the actual overhead. If we're using multiple cost pools, we would have the costs in each of those cost pools. Okay, compare that to the standard price, which we decided was 12, and the number of hours or whatever the activity is that we're using as a cost driver. So we should have paid $12 and we used 4,400 hours because we're using the same as we did for the labor. And so we have a price variance unfavorable, slightly higher amount that we spent than $12. On the efficiency variance, we use standard price is 12 for both of them, but just like before, we used more hours than we planned, right? The plan was here on the far right on the flexible budget, 48,000 versus 52, unfavorable. Okay, both of them are unfavorable. We add them together. Kind of a summary of our variances. And we see that that is an explanation for our 25,680. And if we skip back to one of our earlier slides, that 25,680 was way back right there in the manufacturing variances in this kind of initial profit variance analysis. We just explained in detail that 25,680, where it came from, what caused it, okay, in terms of materials, labor, and overhead. And that's good to know if we're going to try to prevent that from happening in the future. If we don't know what the details are, it becomes very difficult to be able to respond. Okay? So that takes care of our variable manufacturing costs. What about fixed? Fixed are actually even more simplistic, okay, because fixed costs are not affected by the volume, right? So the first variance we're calculating, we're just going to compare what we actually spent on our fixed overhead with the budget. Okay? $4,500 favorable. Sometimes referred to as a spending or budget variance, whatever you want to call it. Okay? It was less than what we planned, so it must be favorable. Now, the volume variance, okay, or production volume variance only happens because of the fact that we had a lot fewer units made than what we planned. So our budget was $200,000. We already knew that. And what happened is, as we went about our business, we applied 160. Because when we started the year, we had a plan of $200,000 budget and 100,000 units. So that's a $2 per unit predetermined overhead rate. But we only made 80,000 units. So we only applied 160. So the difference is 40,000 units. And why did that happen? That happened entirely because of the difference in our sales versus what we planned. So some people would say that's uncontrollable, especially in the manufacturing part of the business, right? Because that's really a function of sales. So we aren't going to spend a lot of time thinking about that variance, all right? But it does explain the difference between what we have as actual overhead and what we have applied in our process. Remember, applying the overhead would involve whether it be we apply overhead to jobs, you apply overhead to departments, you apply overhead to units. We've done that in activity-based costing, we've done that in job costing, we've done that in process costing. Okay, so we're talking about that overhead and over or under applied overhead concept that we introduced several chapters ago. Now, in the appendix to this chapter, okay, and we're going to review this a little bit more in chapter 17, okay, is recording our costs using the standard cost system. So some companies, not all companies, some use standard cost only for evaluation purposes, like we just did. Other companies will actually make journal entries using a standard cost. Okay? And so what happens with that is we actually use the amount that we should have done as the amount we're going to debit in work in process. Okay? So we would credit accounts pay. Let's say we're buying materials. We would credit accounts payable for what we actually bought, right? Because that's what we actually need to pay. Accounts payable. We would debit raw materials, okay, or work in process if it goes right into the process, for the amount we bought at the standard price. All right, because it doesn't really matter what, from our accounting standpoint, we're ignoring the fact that we spent more or less than we planned and only recording what we actually planned in terms of pricing. Then when we use it out of materials or already in work in process and move it on to the next stage, okay, we would use the amount, it's the standard cost, and the standard amount that we use. So if we use more or less, okay, than what we planned, we would still move only what we plan to move. How do our journal entries balance? We actually make debits and credits to accounts called variances, which then go to cost of goods sold, typically at the end of the accounting period. All right? So we'll pick this up in more detail in Chapter 17 and show some examples of the debits and credits. But the idea is we actually recording in the journal, in our T accounts, in our journal entries, the standard costs. We obviously have to record in cash, accounts payable, accounts receivable, those kind of things, the actual. And so the difference, so that the debits equal the credits, go in the variances accounts. And we literally have an accounts called variances, which would then be actually analyzed at maybe at the end of every quarter, or maybe at the end of the year, to see what's causing the variances. So we would look at variances not just individual month by month, but maybe in total. See, we might expect a unfavorable variance one month and then a favorable variance the next month, and those would kind of offset each other. What we get more concerned about a trend that's always unfavorable or a trend that's always favorable, and how are we going to address that? And that would show up in the T accounts if that were the case.